Bell rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager. Hello, I'm Professor Code and this is the Forex Super Model video on bounce trades, how we made 42 points or pips in 5 minutes. And that's on the Tuesday the 1st of the 11th 2022. Thought you'd be interested in the thought processes and generally the process we went through to do that, so you can maybe have a go yourself. Right, US ISM manufacturing PMI was the trigger. We had a buy order on the dollar yen, and that was the trade. Let's say we made about 42 points, just over 42.1 pips or points in 5 minutes on the dollar yen. And the dollar yen, as far as volatility is concerned, is about 150 on our scale, and the lowest being 100 and the highest being 400. So it's just below half marks. Half marks for volatility is about 200. So it's not a real goer, but it's got a bit of movement in it anyway. So that's where we were for that. If you look at the economic calendar for Tuesday the 1st of the 11th, you'll see that there was a bit of primer data out at 13:45 GMT. It was the Tier 2 S&P Global Manufacturing PMI, which came in positive above 50, so it was plus 50.4. Now, as we know, anything above 50 is expansion and below 50 is contraction. Now, we've been in contraction phase slightly, so this was a good sign. So this was like a warm-up, if you like. You have to get yourself in a position where you know pretty much what's going on in the markets. You don't have a lot of time to think on these trades about which direction, all the rest of it. So we're waiting then 15 minutes for this trigger data, which was at 1400, which was the Tier 1 US ISM manufacturing PMI. So we weren't aware of that at the time. So we looked at all the dollar pairs as this was dollar data, the $7 pairs which we've been talking about, and we decided that given the overall setup of the market, the dollar yen had been sold off pretty much and was starting to recover and was sort of looking like that really. In the good old days, the dollar yen, you got a transmission mechanism via equities. So you got the S&P 500, the Nasdaq or tech, and Wall Street, the Dow, effectively. So we're keeping an eye on equities, and equities had obviously had a pasting, and we're starting to look about thinking it had a similar look to them. The tech particularly had a pasting, and it was looking at similar at that tick. So the market was thinking about having a go on the up, and not only that. We've got this Fed rates decision tomorrow evening, and the FOMC minutes, and people have been sort of talking about Fed pivot, which basically means putting the handbrake on the rising interest rates. And if you watch our early morning video, which also includes horse racing, we didn't think this was the correct stance. We thought the Fed was going to carry on with a more stronger rate rise regime, and therefore this little window of dollar weakness, which was in the Asian session and early European session, was likely to be faded, and so it seems. So we had this sort of like primer then at 13:45. That was a good sign, and the sort of market had all the airs of they were going to take their foot off the dollar yen and punch up the dollar yen in that way. So when equities go up in the good old days, you used to get a transmission on the dollar yen, so you used to get positive transmission. The yen used to weaken. They used to sell the yen via the carry trade, and everything was coming up roses. So that's the way it used to be, and that transmission is broken down to a degree, but it's still there, it's still underlying there. So anyway, so that was right. So we stuck an order in 2 or 3 minutes prior to this 1400 data release, about 8 to 10 points above the market because we had a buy order, and then we monitored it closely because you mustn't get your order filled before the data, because you can be hurt badly if the data goes the wrong way as well. So you need to be fingers on the button really. So that's 2 or 3 minutes before the data, and if it's very volatile, you need a bigger order gap really. But we got away with about 7 or 8 points or pips, and then we were waiting for this data to come out, and the data came out in our favour. So we got a positive PMI at 50.2, which is again in the expansion phase, which sort of means the American economy is starting to be strong again, or is strong, and therefore you're likely to see a bounce in equities, and therefore a rise in this dollar yen. And as it happens, so we got our order triggered. We ended up being about, I don't know, about 10 points to the good after the initial spike, and then it dirged around, and then it started to basically sort of generally move up with a couple of pullbacks and all the rest of it, so that was pretty good. Once we got the order in, we then put a slightly above break-even stop to allow for slippage. So if your opening is 147.530, say, and you want a break-even stop, and you don't want to have that annoying like minus half a point or whatever because of slippage, then what we normally do is we normally go 1.475, and we normally stick on about 0.3 of a pip, just to allow for a little bit of slippage in the execution, so that we will get break even if more than likely if it goes to break even. So we did that. So basically we were in for free there, and then it was just a case of deciding when we were going to get out, and the market took us up about 40, 45, 46, 7 points at the peak, came back a couple of times, and then we decided, well, enough's enough, and by which time we'd been in the market about 3 or 4 minutes. So really, to be fair, you're looking at 10-minute trade really, not 5-minute trade, but in terms of actual trading, you're in the market no more than 4 or 5 minutes in that instance, and we took a view that was good enough, and so we took it out of 42.1 units profit, and that was okay for us. So that's the way you can work it really. You've got to make sure that you're fully with it on the overall status of the market. It sounds easy, people who try this and just stick in orders like high and low on every data point tend to come unstuck. You've got to actually give yourself a chance and have sort of secondary triggers, and be in a very good position to know the transmissions through the market, and that comes with experience. But that's a good one to learn from really. As I said, the key things there were we had this heads up on the 1345 data, the tier 2, and then we had this transmission through the equities. We could see that equities were thinking about helping us out, and then we had this this dollar yen carry trade risk on transmission, which helped us out, and then obviously the data itself helped us out, because if the data had come in, I don't know, 49.9 or something, then the order wouldn't have been filled more than likely, and we'd have just chopped it out and looked for another trade another day. So that's where we are. Anyway, I hope that's been useful to you. The advantage of this method is you don't have to stay glued to the screen all day watching every pip. But what you do have to do is spend your time getting up to speed on the way the transmissions in the market work via the data as it comes out from the economic calendar. So anyway, I hope that was useful, and we'll try and do some more videos as we go along, as we get some more trades out. So thanks for watching, thanks for subscribing, and goodbye.